Hi everyone, so let's now have a look at the price elasticity of supply. Now when it comes to the price elasticity of supply, we're really trying to understand how sensitive supply changes are to any change in the price level. And we can see this definition here, measure the responsiveness of supply to a change in price. So as price changes, to what extent will businesses actually try to adjust their supply levels? So in the case of a price increase, of course, businesses will want to provide an increased level of supply. We know there's a positive relationship between price and quantity supplied. That's why we have that upward sloping supply curve, of course. Okay, now this is calculated in much the same way. We've got queens over princes, but in this case, we've got the quantity supplied divided by the price here. So it's not quantity demanded, but of course quantity supplied. So let's just run through a nice straightforward example. Perhaps there is a 10% increase in the price level. Well, if the product is price sensitive or supply sensitive there, then we would also see perhaps an increase of the quantity supplied of maybe 50%. And that would tell us that there is a price elasticity of supply of 5. That is, for every 1% change in price, the quantity supplied to the market will increase by 5%. Okay, a 2% change in price would govern a 10% change in the quantity supplied at that level. Okay, so what does this mean? Well, just behind me here, I've put down that anything greater than 1 tells us that we have a particular type of product which is supply elastic. So that is, it is sensitive. The supply curve is sensitive to price changes. And we can see that in this example that I've just drawn up here. So this would be a highly elastic supply curve. It's highly price sensitive. So a 10% increase in the actual price level means that businesses want to increase the quantity supplied by 50%. So a big increase there. Okay, now let's just contrast this with a more inelastic or insensitive or unresponsive supply curve. Here, a 40% increase in the price level would only increase the quantity supplied by 20%. Okay, so a very different circumstance. So let's just work through the actual figures that we've got here. So we've got a 40% change in the price over 20% divided by 40%. So of course that would lead through to a price elasticity of supply of 0.5. Okay, so that is where there is a 1% change in price, there is a 0.5% change in the actual quantity supplied. A 40% change therefore gives a 20% change in the actual quantity supplied. And it is less than 1, so it is therefore supply inelastic. Okay, let's have a look at some of the reasons behind this. Okay, so we see here that a production or a time lag can have a significant effect. So how long it actually takes to actually produce a good can have an implication for the actual elasticity of supply. So when it comes to perhaps having a custom-made Harley Davidson, you may be looking at this sort of scenario where the actual supply curve may be fairly unresponsive to any increase in the price level. Okay, because it takes time, perhaps it's handcrafted, perhaps it requires particular ingredients or component parts which are difficult to source and so on. But further to that, we've also got this point about the time lag, and that of course is particularly apparent in the production of crops and agricultural products more generally. So agricultural products generally do have, in the shorter term, highly inelastic supply curves. So the actual supply of those goods cannot be increased dramatically in the short run, but in the longer term they will be increased. Okay, so moreover, we can also see there's the point here about the spare production capacity. So how much spare production is there? To what extent can a given business actually increase their production capacity? Perhaps they may have actually deliberately just employed workers on a part-time basis during a recession, and then as the economy begins to grow once again, they then invite those workers to take on full-time work perhaps, as well as recruiting more workers because they're not using their entire capacity. So how much spare production capacity can therefore enable us to actually see a more elastic supply curve, assuming there is that capacity available. Then existing stock levels. So if there's existing stock in place and there is a surplus of stock available, then it's likely to mean, of course, that we are dealing with a elastic supply curve. Okay, further to this, we've got factor and occupational mobilities. So our factors of production, land, labour, capital, how easily can they actually move between different roles? And perform different jobs to produce different goods. So how easily can that actually take place? And then we've got occupational mobility as well, and that is how easily can the labour force actually move from one particular industry or one particular sector of the economy to an area which is perhaps enjoying an increase in price levels. If factors of production and labour can easily move between those sectors, again, you're likely to see a more elastic supply curve. But once again, there is likely to be a time lag in terms of how quickly that takes to actually occur. Okay, so lots and lots of interesting points here. All right, hope that's all right, guys. Thanks a lot.